Namaste. This is my third video on stock market, and today I will not be talking about cash market or derivatives market, which were the contents of my video number 1 and video number 2. Today I will be talking about the basic stock market terminology. So take you a little bit further in your knowledge about stock market. So various terms which we use on a regular basis if we are dealing with stock exchange. So the first one is the annual report. Now, when you talk about annual report actually informs shareholders about the company. It includes the information like the company's cash flow and the management strategy. When you read an annual report, you are judging about the company's solvency and financial situation. Solvency means liquidity, and the financial situation means the financial performance and the financial position as well. Every public company needs to publish its annual report to inform the shareholders and other stakeholders of its financial performance, financial positions, liquidity, and strategy for its future. So that's your annual report. The second term I'm going to discuss is arbitrage. Arbitrage refers to buying and selling. So it's buying and selling the same security on different exchanges and at different price points. So I'll give you a small example. So if a stock trades at, for example, 10 pounds on one stock exchange and 10 pound 50 pence on another. So 10 pounds on one and 10 pound 50 pence on another, you could buy shares for 10 pounds and sell them for 10.50 on the other market. And obviously you will pocket the difference as your profits. That's arbitrage. The third term is the bear market. You must be aware of this term, bear market. It refers to a market environment where a major index or stock falls 20% or more from its recent highs. So where the stock falls 20% or more from its recent highs. It's the opposite of the bull market, which I'm going to discuss in a few minutes time. So bear market is where a major index or stock falls 20% or more from its recent highs. Next comes the bull market, which is obviously, as I mentioned, is the opposite of a bear market. It refers to a market in a prolonged period. It refers to a market in a prolonged period of increasing stock prices, at least 20% above a recent low. So bear market means it's going down, and bull market means it's going up. And when you compare going up and going down, it's 20% or more. When it goes down from its recent highs, that will be bear market. And when it goes up 20% or more above the recent low, that's your bull market. The next term I would like to discuss is the beta. Beta is the measurement of the stock's volatility compared to the overall markets. So stocks volatility compared to the overall market. The markets are assumed to have the beta of 1. So if a stock has a beta of 1.2, for example, it means that for every 1 point above, it means that every 1 point move in the market, the stock moves 1.2 points, meaning stock is more riskier than the market. And obviously, if the stock is more riskier than the market, shareholders will expect more return. So higher risk, higher return. Next term, maybe you have studied this term before, or you might have heard this term before. It's the broker. A broker is a firm or a person who executes. So a firm or a person who executes your buy and sell orders for stocks or other securities. It is a must for every trader. They know what they are doing and they excel at doing that. So they are the people who will execute your buy and sell orders for stock and other securities. Bid. The next term is the bid. It is the amount of money. It is the amount of money a trader is willing to pay. It's the amount of money a trader is willing to pay per share for a stock. It's balanced against the ask, which is what a seller wants per share of that same stock. So bid is the amount which the trader is willing to pay, and ask is what seller wants per share. Sorry. Next is close. It is the time the market closes. The time the market closes. The major exchanges close at 4 p.m. However, after hours trading continue until 8 p.m. I apologize for that. Day trading. The next term is day trading. It is the practice of buying and selling a stock. It is the practice of buying and selling a stock or a security within the same trading day. You buy and sell the security within the same trading day, then it's known as day trading. The next is a very easy term, dividend. It is the share in the profits of the company. Now, shareholders get the dividend quarterly or annually. However, please keep in mind, it is not an obligation on a company to pay dividends. And to be honest, not all the companies pay dividends. There is no statutory right. Shareholders have to get the dividend. Obviously, directors would like the shareholders to be happy. And if they have got enough profits and if they have got enough cash to pay the dividends, then they will pay the dividends. But if they would like to reinvest the money for future purposes, they might decide not to pay the dividends. The next term is execution. When you buy or sell order completes, when you buy or sell order completes, it is called execution. So basically, if you put in an order to sell 100 shares, so if you put in an order to sell 100 shares, your order executes when all the 100 shares are sold. The next one is very, very interesting. It's haircut. Haircut. Now, a haircut can have two meanings. It can refer to a thin spread between the market maker's bid and ask. So it's the thin spread between the market maker's bid and ask, but it can also refer to the difference between the stock's value and amount a bank will recognize as collateral for a loan. So a thin spread between the market maker's bid and ask, but it's also known as, or it can also refer to the difference between the stock's value and the amount a bank will recognize as a collateral for a loan. Next one is high. A high refers to a stock or index reaching a greater price point. A stock or index reaching a greater price point. A high can refer to a daily, weekly, or monthly high. Stocks near 52 weeks high or all-time highs can be a bullish signal for traders. So high is a stock or an index reaching a greater price point. And opposite of it is a low. It represents a lower price point for a stock or index. Then we have IPOs, initial public offering. An IPO is the first sale. It's the first sale or offering of a stock by a company to the public, the very first time. The Securities Exchange Commission has strict rules for companies issuing an IPO, and all the public companies, they will need to adhere to all these rules and regulations. The next one is a leverage or leverage. When you use leverage, you borrow capital from your broker with the goal of increasing profit. So you borrow capital from your broker with the goal of increasing profits. It's one way to potentially increase gains, but it also increases losses. My advice is don't trade with leverage. Don't do that. Don't trade with leverage. The next one is a margin. A margin account. A margin account lets a trader borrow money from a broker to purchase a stock or an asset. It is the difference between a loan amount and the securities price. That's your margin. The next one I would like to discuss is open. Open is the start of the trading day. So for example, in US, the stock market opens at 9:30 a.m. Normally, there is less volume in pre-market and after-hour sessions. Most of the trading happens during the day. Next one is portfolio. Portfolio is the collection of assets that makes up a trader or investor's portfolio. So don't put all your eggs in one basket. Do not invest all your money in the shares or stocks of one company. You should create an investment portfolio. So you can have, well, you can have as few as one stock in a portfolio or an infinite number of stocks or other securities. Normally they say about 20 to 25. Next, a quote. A quote is the stock's latest trading price. So stock's latest trading price is known as a quote. Stock quotes are free websites which presents usually delayed information. If you want the real-time data, you might have to pay a little bit extra. The next one is a rally. A rally is a rapid increase in the general price level of the market or of the price of the stock. I repeat it. It's the rapid increase in the general price level of the market or of the price of a stock. Depending upon the overall environment, it can be either a bull rally or a bear rally. And we have already studied these terms before, bull and bear. So in a bear market, upward trends of as little as 10% can qualify as a rally. Next one, a sector. Sector is a group of stocks. It's a group of stocks in the same industry, which belong to the same sector. So example, when you talk about the tech centers, it can include the companies like Apple and Microsoft. Some traders, it depends upon, individual preferences. Some traders, they prefer to trade in a specific sector, especially when the sector momentum is hot, whereas other traders, they would like to have varied portfolio. The next one, spread. Spread is the difference between the stock's bid and ask price. So for example, a very simple example, if a trader is willing to sell a stock, if the trader is willing to sell a stock for example, $10, and the buyer is willing to pay that same stock for $9, the spread is $1. So if the trader is willing to sell the stock at $10, but the buyer is willing to sell it at, the buyer is willing to buy it for $9, the spread is $1. The next one is a stock symbol. A stock symbol is an alphabetical symbol or alphabetic symbol of 1 to 4 characters, which represents a publicly traded company on a stock exchange. So basically, for example, Apple Inc. stock symbol is AAPL. So it's an alphabetic symbol, generally 1 to 4 characters, which represents a publicly traded company on a stock exchange. AAPL for Apple Inc. Volatility. Volatility basically is the price movement of a stock or the stock market as a whole. Highly volatile stock makes extreme movements and make wide intraday price swings as well. Next is volume, which is the number of shares of stock traded during a period. So the number of shares of stock traded during a period is known as the volume. Final term is yield. When you talk about an yield, it is the measure of return on an investment, such as a dividend payment. In very simple terminology, it is the annual dividend payment divided by the share price or price of that stock, which is expressed as a percentage. That is known as the dividend yield. Dividend yield. And that's it. Those are all the basic terms which I wanted to discuss today. In the next session, I will bring some more terminologies and I will try to do some numerical examples as well. I hope it is making sense. Now we are moving in more detail, in more depth of stock market. If there is anything else you would like to discuss within this topic area, please let me know. And if you have any doubts, please put it as the comment and I will try to resolve the doubts. If you like my videos, please subscribe to my channel, press the like button, share it, and thank you very much for listening. Namaste.